Okay, hello, welcome back. This is chapter one. I think I'm going to break chapter one into the three sections. Just in general, I'm going to say that I will try and be brief, concise, and keep these hopefully to 15 minutes or so. And the conciseness, if you miss something, you can always go back and take a look. So I'm not going to repeat myself too much, and I will try and keep on track as much as possible. So our agenda here, the first of the three sections is going to be sort of definitions, a bunch of the structure and general information, and then we'll go into two more sections where we talk about the financial statements and we'll talk about business transactions. So let's go ahead and get started. Okay, so having looked at the agenda, we have the first set of things that we're going to look at is three activities. What are the three activities of accounting? And the first one, pardon me if I sometimes misspell things. Let's see. I'm going to try and adjust my microphone here and move over so I don't have to reach so hard with me when I'm writing. Okay, so the three activities are to identify, record, and communicate. And just a brief explanation of each. Identify, not all business activities are going to be something that the accountant is going to be dealing with. Sometimes there are business activities that are still important to the business but fall outside the accounting treatment. So not all are accounting related. Record, well, accounting is backwards looking. In other words, it's looking at what has happened and trying to record it so that we know, record it precisely or record it accurately. When you get into finance, you're into a more forward-looking type of business discipline. And to communicate, we want to assemble that information that we've recorded, that we've identified, and make it available to decision makers. So decision makers within the company need that information to do what they need to do. So the next one is going to be the who uses the information. So the accountants are putting together all of this information. Who uses it? Well, there are two primary groups of which all the things that we're going to be studying in this course are with the first group. The first group is who we call external users. External users of the information are primarily from these three groups. It's going to be anyone that is maybe an investor. Either they're already an investor, they've already bought stock in the company, or they're thinking about it. There's going to be a group of people called creditors. Who are they? They're people that might want to do business with your company, and they might be a bank who's wanting to give you a loan, or maybe they're a vendor wanting to give you credit or to sell you product. And so they might want to look at your accounting information to see if you're someone that they want to do business with. And then, of course, we can't get away from it, but the government is also interested in all that information. And primarily, there's a couple of different ones, but initially we'll be talking about the IRS because, the government needs accurate information to do what? To have taxes. So those are the three primary external users. Now, once you get a little bit further on in Principles 2, you'll learn that there's another group of people that uses information, and that's internal users. Basically, managers and whatnot within the company looking to make and other decision makers. But we won't address that until much later on into Principles 2. For right now, the external users, well, if we have all these external users, these investors and whatnot, we need to kind of talk about what are going to be the general principles of this information. How are you going to structure this information for external users? Well, by the very nature that they're external users, let's focus maybe just on investors right now. An investor may be looking at a whole bunch of different type of companies, maybe a car company or a software company or a service company, like a lawyer or something like that, or, a software, some other type of service, or maybe a manufacturer. These are all different types of company. Now, rather than have a whole bunch of different type of information coming out of these different companies, you want to kind of have this information to be standardized so that any potential investor can look at a whole bunch of different companies' information and be able to compare them. So we standardize them we standardize the information and make it comparable so that investors have a relatively, I guess, easier time to be able to decide who they want to invest in. And if we're going to be able to compare it, well, that kind of basically means that there needs to be rules. There needs to be rules about how all this information gets presented. Now, these rules for accounting are called GAAP, and that stands for Generally Accepted Accounting Principles. Well, maybe back in the 1940s, we talked about generally accepted because we hadn't figured out which rules we were going to follow. But now, over the course of many years, we should rename this as mandatory accounting principles. You can't not do GAAP. Let's look at some other principles on the structure. So if we've got a whole bunch of standardized and comparable information, what other things are we trying to achieve with this information? Well, we want this information to be relevant to the users, meaning not a whole bunch of fluff, information that they find useful for making decisions. It should also be a faithful representation. In other words, any information we put together is going to be sort of a summary of the business transactions in the company. They can't be every little detail about every transaction. So what we want to do is we want to try and faithfully represent the substance of the transactions as well as we can. And remember, we're talking about past transactions. The next thing we want to do is, at least for GAAP, I'll just point out, is only used in the US. Other countries use other type of accounting rules, but GAAP is US. So in the US, you can imagine, therefore, what is another thing that we're going to do? We're going to say, well, it has to be done in the US dollar. Our financial statements can't be done in shekels or beads or whatever else. It has to be done in US dollars. And we call this this is sort of one of those measurement principles. So this is a measurement principle. We're going to measure everything in dollars. Another thing that we talk about is something called historical cost. When we purchase land or we purchase equipment or other type of inventory, we put these things in our records at the price we originally bought it, the original price. Now, these things may go up or down in value. I'll put cost rather than price. These may go up or down, but we don't change that value on the books. We keep it at historical cost and maintain that through, because we don't really know what's the actual value until we do a transaction, until we sell it. So in other words, we may believe this land is worth more now than when we bought it 10 years ago, but we don't actually know for sure until we sell it. So historical cost. Now, I will say that the opposite of historical cost is that there are places within accounting that we could do something called fair value, which, as you can imagine, is the current cost, or the current value. Cost, we'll call it current cost. Now, there's only a few places, and if you get further on in accounting, if you're an accounting major, we do deal a lot with fair value. But for most what we're going to do here in Principles 1 and 2, we're going to focus on historical cost. But just for completeness sake, just to let you know, there is a fair value proposition that we can look at. The last area that I want to focus on is going to be, okay, we've got standardized information relevant, it's in the US dollar, historical cost, and we want to know, well, what type of business structures are we talking about? And we call this an economic entity. So what sort of things are we recording all this information for? So we'll look at just kind of a brief overview of some of the main ones. There's a sole proprietorship. There is a partnership, and we'll get more into the weeds with this as we go on, but let's just take a look at kind of a quick overview. And the last one is corporations. Now, fortunately or unfortunately, these three things typically have a little bit of differences, and they differ because an economic entity in accounting has both a legal and an accounting definition. And typically when we talk about legal, we're talking about liability. Can you get sued? And when we're talking about accounting, we're talking about what is the tax implication. So for proprietorship, that's just one person running a company in their own name. What we have here is the tax is very simple. It's something we call pass-through. In other words, whatever the proprietorship earns doesn't get taxed at the proprietorship level. It passes through that business onto the individual's tax returns, which is a favorable thing. That makes it easy, and that there's not multiple levels of taxation. However, a proprietorship, the person is individually liable, and we say this is unlimited liability, for all the debts and the misdeeds of the company. So if something happens bad in the company, people can sue the company, and the people can others can sue the individual owner. So most times when we're talking about unlimited, like unlimited buffet, that's a good thing. But unlimited liability is not a good thing. That means anyone can sue you. Not just the company, they can sue you, the owner, individually. And same with partnership. A partnership is sort of like a proprietorship. There are differences, but it's 2+ people. And similarly, it has unlimited liability. And you see here, it's even a little worse. You can be sued not only for the things you do wrong, but you can be sued for the things that you had nothing to do with, but maybe your partner did wrong. But on the favorable side, it is a pass-through, meaning it's not taxed at the partnership. Income is only taxed at the individual, at the owner's level. Corporations, well, this is, again, it flip-flops. On the legal side, there's limited liability, meaning if someone sues the company, they can only sue the company. They can't sue the stockholders or the owners or the CEO or that sort of thing. So now, of course, if you're a shareholder, you can lose all the money you invested in the company, but they can't go after your personal assets as an owner or a shareholder. However, under the tax part, there is a double taxation issue. And what do I mean by that? It means that at the corporate level, the government taxes the profits of a corporation. And when the corporation distributes profits to the shareholders, which we call dividends, dividends are taxed at the personal level too. So there are 2 levels of taxation before you can get your money before you can get any profits out of a company. So those, you can see that these first 2, they have unfavorable legal situation, but a favorable tax situation. The corporations have a favorable legal situation, and it's not that unfavorable. It's just how it is, double taxation. If they could have thought of a better way, they would have done it, but they haven't. So that's the way we've kept it for now. Okay, well, so we're going to go ahead and wrap up the definitions here, and then I will continue on in the next video with, let's see, I'll probably do the financial statements next. Okay, thank you. I'll see you in just a moment.